Hi, my name is Erenstoft, and this is the E3 Rate of the Union. These periodical reports guide and navigate you through the economic happenings to keep you clear on the economy and interest rates. Many are asking, well, what is going on with interest rates, inflation, prices, and the markets? What can I expect? Well, I'm going to give you an update that you can actually see for yourself. You can observe it. It's happening around you. You don't have to be an economist to even see this because it's happening. So here we go. Why did interest rates go up in the first place? Let's start there. Well, the Fed observed and the market observed that inflation was up. This means that people are buying too much, consuming too much due to a very favorable economy post our recovery. Higher consumption pushed prices higher and upward, and thus inflation resulted. Well, what did the Fed do? Well, the one thing that they can do, they raised interest rates. What does that do? It discourages buying stuff. It creates a headwind. So it slows consumption, and the idea is to reduce inflation. And by and large, it has worked. It has brought inflation down, not to the target, but low, relatively low regardless. So it has worked and normalized. There are target benchmarks that the Fed and we can watch in order to indicate that. Now, how do we know it's too much? Well, think Goldilocks, too hot, too cold, just right. When buying stuff is slowed too much, what happens? Well, let's go on the other side. Let's go, if you're a business and you're selling stuff. Well, the businesses that sell stuff to you, if you are buying less from them, that means that they are selling less. That means that their revenue is down. Well, if that happens for a while and you're a business owner, it means you don't need to produce as much stuff. And because you're not selling stuff as quickly, what do? Well, you could start laying people off. You don't need as many employees. So one of the observations and indicators that we want to watch is unemployment increasing. So you will notice that unemployment numbers going up if this is happening. Can this be a problem? Well, if too many are unemployed, then yes, this slows buying even further and worse. And larger numbers of people are unemployed for an extended period of time. They begin to miss paying their bills. Maybe they're late on rent or miss a mortgage payment, further accelerating this issue. And we've heard of the term soft landing. Well, that was the idea of the Goldilocks being just right. If unemployment accelerates, it can become less easy to control and increase, causing an excessive slowing of the economy. Nobody wants this. So you get the dynamic now. So what are we observing and watching for? Well, here are some indicators and some news real time. S&P Global Market Intelligence Report shows an elevated number, a ticking up, of small and mid-sized businesses in the US that are struggling to survive. Now, this is an indicator that is higher than it has been since 2010. Okay, something to watch. Jobless claims rose, the highest level in 3 years. Non-farm employment in July came in below expectations. Now, core inflation is at 3.3. In many market opinions, this is pretty okay, despite a target closer to 2. So, okay, one reporting period does not a trend produce. We want to continue to observe and see if a pattern trend emerges and adjust accordingly. The economy is still buzzing along. Markets are strong with normal amount of volatility now and again. We saw one blip last week and they pretty much recovered from there. So the Fed met last week and voted to leave the benchmark interest rates unchanged. They didn't cut, but they hinted the possibility in September. So what do I think? Well, we need to go back all the way before the beginning. Remember when interest rates were 2.5%, and that really got us out and got the market stimulated. But after it was stimulated, they kept the interest rates low for 6 to 12 months beyond when they should have already started to raise interest rates. And where do we see the effect? We see it down the line several years later. And now we see a misalignment because we still need to get to inflation targets down, but we don't want to spur too much unemployment, and yet we're not quite there. So the Fed should not cut interest rates in September, but they might because of this disconnect. And it is from the laggard that came from leaving them low too long initially. So we want to watch this and observe this. I've been maintained that they should not be cutting before 2025. They might in September, as they've indicated. And so watch the markets, watch the economy, watch unemployment numbers, look around at the businesses. How are they doing? How is business doing? Is consumption slowed? Is it slowed too much? Are you seeing people increased unemployment? Are you seeing businesses go out of business? Things like that. You see it around you, observe it, you feel it, and the consumer confidence, things like that. And we're going into an election year, so have fun sort of navigating around that. But that is a whole different beast, and it can affect things. But that happens every 4 years anyway. My name is Erenstoft. This is the E3 Rate of the Union, and have a good month, everybody.